You are looking at a listing for a 3-bedroom ranch in a quiet suburb of Ohio. In 1971, your father bought this house for $25,000. He was 24 years old, working a mid-level manufacturing job. His mortgage was less than 20% of his take-home pay. Today, that same house is listed for $480,000. To afford it, you need a 6-figure salary, a $70,000 down payment, and a credit score that borders on perfection. But here's the terrifying number. While home prices have surged over 400% since the 70s, real wages have crawled up by barely 15%. The American dream wasn't just lost, it was liquidated. Your bank account isn't as safe as you think, and the roof over your head is no longer a shelter. It's a speculative asset owned by people who will never step foot inside it. This is the autopsy of the American home. This is why you can't afford to live where you grew up. To understand why the market broke, you have to understand when it was fixed. Post-World War II, the US government made a deal with the middle class. Through the FHA and the GI Bill, they subsidized the 30-year fixed-rate mortgage. It was a social engineering masterpiece. It turned a nation of renters into a nation of owners, tethering the population to the land and the economy. For 30 years it worked. A single income could buy a piece of the world. But in 1971, the clock started ticking. August 15th, 1971. Richard Nixon ends the direct convertibility of the US dollar to gold. The Nixon Shock didn't just change currency, it changed the nature of debt. Without the gold anchor, the money supply exploded. Inflation became a feature, not a bug. Did you know that before 1971, the median house cost roughly 3 times the median annual income? Today, in many American cities, that ratio has spiked to 8, 10, or even 12 times. As the dollar lost its value, the wealthy realized they needed a place to park their cash where it wouldn't melt away. They chose real estate. Suddenly, the home was no longer just a place to raise a family. It became a hedge against a dying currency. The flaws were hidden at first. In the late 70s, the system looked stable, even as inflation began to boil, but the key players, the central banks and the Wall Street architects, were already shifting the floorboards. They were moving from a production-based economy to a debt-based economy, and you were the collateral. The fuse was lit in 1971. It would take 50 years to reach the powder keg. And for the millennial generation, the explosion happened exactly when they were told it was their turn to buy in. By the time the first millennials entered the workforce in the early 2000s, the ticking clock was deafening. The old world of save and buy was dead. It had been replaced by a high-stakes game of leverage, where the only way to win was to gamble with money you didn't have. But the house always wins. And in 2008, the house was about to come down. The first crack appeared in the late 1970s. Inflation, unleashed by the abandonment of the gold standard, began to erode purchasing power. Mortgage rates, once stable, started their ascent. By 1981, they peaked at over 16%. This wasn't just an inconvenience, it was a barrier. For the first time in decades, homeownership became a distant dream for many working-class Americans. But nobody noticed until it was too late. The narrative of ever-increasing property values had already taken root. The 1990s brought a brief reprieve. Mortgage rates declined, fueled by the dot-com bubble and a shift of investment into fixed-income assets. This created a false sense of security. The underlying structural issues, the decoupling of wages from housing costs, the financialization of housing, were ignored. Instead, the market interpreted this as a sign of inherent strength, not a temporary anomaly. Then came the 2000s, the era of deregulation, the era of the subprime mortgage. Wall Street, always seeking new avenues for profit, discovered a gold mine in the American dream. They packaged risky loans, sliced them into complex financial instruments, and sold them to unsuspecting investors. The mantra was simple. Everyone deserves a home regardless of their ability to pay. This wasn't altruism, it was engineered greed. Between 2000 and 2006, the median home price in the US surged by over 50%. During the same period, median household income barely moved. How did millions of Americans afford homes that were rapidly outstripping their earnings? They didn't. They borrowed. And the system encouraged it. The Federal Reserve, in an attempt to stimulate the economy after the dot-com bust in 9/11, kept interest rates artificially low. This fueled a borrowing frenzy. Lenders, incentivized by the promise of quick profits, abandoned traditional underwriting standards. No-doc loans, interest-only mortgages, adjustable-rate mortgages, these were the tools that inflated the bubble. You were told it was an opportunity. It was a trap. Homeownership rates soared, reaching an all-time high of 69.2% in 2004. But this wasn't a sign of prosperity. It was a symptom of systemic rot. The foundation of the American economy was being built on sand. The tide was coming in. The year was 2007. The first tremors were felt in the subprime market. Defaults began to rise. At first, they were dismissed as isolated incidents, a problem contained to the riskiest borrowers. But the contagion spread. The complex financial instruments designed to distribute risk instead amplified it. Nobody understood the true extent of the exposure. Lehman Brothers, Bear Stearns, AIG, names that became synonymous with failure. The financial system, once thought to be impenetrable, began to unravel. The panic was palpable. Credit markets froze. Banks stopped lending to each other. The math behind the crash was brutal. Trillions of dollars in phantom wealth, built on inflated housing values and reckless lending, evaporated overnight. Your parents, your neighbors, your friends, they watched their equity disappear. Foreclosure signs sprouted like weeds in suburban lawns. The dream turned into a nightmare. The government, caught flat-footed, scrambled to prevent a total collapse. Bailouts, stimulus packages, quantitative easing, these were desperate measures to prop up a broken system. In the wake of the 2008 crash, nearly 10 million Americans lost their homes to foreclosure. That's roughly 1 in 10 homeowners. The human cost was immense, but the lessons were quickly forgotten. The Federal Reserve, in an unprecedented move, slashed interest rates to near zero and embarked on multiple rounds of quantitative easing. The goal was to stimulate the economy, to make borrowing cheap again. It worked, but with a devastating side effect. It supercharged asset prices, including housing. The very policies designed to fix the crisis laid the groundwork for the next one. The cycle was not broken, it was merely reset, with the same players holding even more power. The pattern is always the same. It repeats relentlessly. The Capital Codex reveals it in every crisis, every collapse. It's a 5-stage cycle: complacency, excess, warning, panic, reset. Complacency. After the 2008 crash, the public was told the system was fixed. Regulations were put in place. The banks were too big to fail, but now they were too big to let fail. The memory of the collapse faded. People returned to their lives believing the worst was over. This was the era of cheap money, of quantitative easing, of a slow, insidious inflation that didn't show up in official numbers but was felt in every grocery store and gas pump. Excess. With interest rates near zero, money became effectively free. Corporations borrowed to buy back their own stock, inflating share prices. Private equity firms, flush with capital, began to buy up single-family homes, turning them into rental properties. The housing market, once a place for families, became a playground for institutional investors. This wasn't about providing shelter, it was about extracting rent and financializing every square foot. Today, institutional investors own a significant and growing portion of single-family homes in key markets. In some cities, they control over 20% of the single-family rental market. Your landlord might not be a person anymore. It might be a hedge fund. Warning. The warnings were there. Economists, housing advocates, even some within the financial system pointed to the rising debt levels, the stagnant wages, the increasing unaffordability. But these voices were drowned out by the chorus of optimism, by the endless drumbeat of housing always goes up. The Federal Reserve, despite its mandate to maintain price stability, continued its easy money policies, fearing a recession more than a bubble. Panic. The pandemic hit. Initially, there was fear of a housing collapse. Instead, a new kind of panic emerged. Fueled by remote work, low interest rates, and a desperate search for space, demand for housing exploded. Supply, already constrained by years of underbuilding and zoning restrictions, couldn't keep up. Prices soared at an unprecedented rate. People, terrified of being priced out forever, rushed to buy, often waiving contingencies, stretching their budgets to the breaking point. This wasn't rational exuberance, it was pure, unadulterated panic. Reset. We are in the midst of the reset. Interest rates are rising, not to curb inflation, but to cool a housing market that has become dangerously overheated. The cost of borrowing has doubled in a year. The dream of homeownership, already out of reach for many millennials, is now a cruel joke. The system is rebalancing, but not in your favor. The wealth transfer is complete. The history repeats, but the players change. Today, the warning signs are flashing red, not just for housing, but for the entire economy. You are living through the next chapter of the Codex. First, the student debt crisis. Millennials carry a crushing burden of student loan debt, a weight that directly impacts their ability to save for a down payment or qualify for a mortgage. This isn't just a personal problem, it's a systemic drain on the economy, preventing an entire generation from participating in the traditional wealth-building mechanism of homeownership. Second, the financialization of everything. Housing is just one asset class being devoured by institutional capital. Farmland, infrastructure, even water rights. Everything is being turned into a speculative investment. This creates a permanent renter class, a population stripped of ownership and reliant on the whims of distant, faceless corporations. Your future is being bought out from under you. Third, the illusion of choice. You're told to work harder, save more, cut back on avocado toast. But the game is rigged. The median home price is now over 8 times the median income in many areas. This isn't a gap you can bridge with frugality. This is a chasm created by decades of policy decisions that prioritized asset inflation over wage growth, corporate profits over human well-being. You've seen how the American dream was dismantled piece by piece. But what happens when an entire generation is locked out of the most fundamental form of wealth creation? What happens when the social contract breaks? The housing market is just one symptom of a deeper sickness. Next, we expose the silent killer of your retirement, the pension funds that are gambling with your future and losing.